Hello and welcome to Chapter 16. Now we are ready to complete the audit, but there are a few steps that we need to take before we finish the audit. So what are those steps? And let's discuss those. Besides examining different sections of the balance sheet, auditors will also analyze income statement accounts. We looked at every component of the balance sheet so far, but we do not specifically go and do testing on income statement accounts because they are being sort of tested indirectly. And what we're going to talk about is there are some cases where we do direct confirmation, but let's talk about how the indirect confirmation happens. When you look at accounts receivable, debit accounts receivable, then you credit sales. So we're looking at sales as well. You're also estimating the bad debt expense and uncollectibles by looking at the aging schedules. So you're looking at, simultaneously, you're looking at those expenses accounts as well. Same with notes receivables. Same with, inventories and cost of goods sold. Same with depreciation with property. Same with intangibles and amortizations. So you are indirectly confirming these accounts. Okay. So the aim behind audit of revenue and expense account is to do a combination of cross-referencing and analytical procedures to make sure, for example, property, plant, and equipment. New businesses, they have opened up a new plant. There's a lot of fixed assets acquisition. Obviously, there's going to be higher depreciation expense. They have incurred more debt. Obviously, there's going to be higher interest expense. So analytical procedures is what this is basically referring to. Okay, and this is what you call indirect confirmations. Okay, what we're also going to look at is some direct confirmations in this particular case. So what are our objectives when we look at revenue and expense accounts? This is what we need to read. So we are looking at the assertions again: completeness, accuracy, presentation, and disclosure. Of course, existence of revenue as well. Again, the redundancy factor to emphasize the importance of these things. Okay, you cannot do any audit unless you have a good understanding of the overall control environment. Why this becomes so important and why have we kept on re-emphasizing this chapter after chapter? Think of Enron. What went wrong now that you have done the cases? In many ways, Arthur Andersen did not understand the mark-to-marketing accounting concept because they didn't really question those things. They didn't do the homework. Okay, so that's why these things in a risk assessment, risk-based audit gain its own importance. And that's why we keep on re-emphasizing this again and again. One account we do direct confirmation: miscellaneous revenue. Besides analyzing, we need to look at miscellaneous revenue. Why is that? Bad debt write-off, all of a sudden you collected money. People don't realize that, the journal entry that needs to be done should not go to miscellaneous revenue. We need to reverse the write-off and then, reestablish the receivable and then accept cash. It's a presentation and disclosure thing, but it would be wrong to put it in miscellaneous revenue. Okay? Old outstanding checks are escheatable property and need to be given to the government. Okay? Sales of scrap applied to reduce cost or goods sold, cost of goods sold. Okay? Not necessarily miscellaneous revenue. Rebates of insurance is reduction to insurance expense. Proceeds from sale of plant assets, gain or loss on other equipment. Okay, gain or loss on assets sold. So you're looking at this account primarily to make sure that nothing that is being coded here is being coded incorrectly. Okay, adjusting journal entries should be proposed if any adjustments need to be made, like any other adjustments. So that's direct confirmation. And then there are some expense accounts that need direct confirmation. So let's take a look at those. Advertising, research and development, legal expenses, maintenance and repairs, rent and loyalties. Advertising, pretty basic, right? Subject to interpretation. I advertise. You could, put in stuff that you should not be putting in. Fake expenses go in there. R&D. What needs to be amortized? What needs to be put into research and development? There are some rules that you may have learned in your Basic Accounting 101 class. Are those rules abided by? Legal expense. What are these expenses for? Any hidden lawsuits? Anything that should have been capitalized by error has gone into repairs and maintenance, rents and loyalties. Any secret revenue or any secret expenses or loyalties are being paid that you're not aware of, or maybe they have made a mistake. Okay, so that's the reason why, that's what the AICPA suggests, that you directly investigate these accounts and do some substantive testing. What are these substantive testings all about? Develop your own expectation based on budget. Look at the budgeted numbers, compare it with the previous year. Now, how you do analytical procedure, and you see a big variance, start questioning. Print out the ledger, and then when you do that, you will immediately start getting answers for these kind of things. Okay, look at minutes of the meetings to see if there are some secret charges being quoted here. Investigate deviations from expectations is what substantive testing is going to be about in this particular section. Okay, audit of payroll. That's the next part that we're going to talk about. So let's review this real quick. I would suggest that you read this entire section that I've talked about, and that pretty much explains itself. But once you read this and then listen to what I have to say, it'll make much more sense. Now, when you hire, you're hired by HR. Your salary approval should be done by HR. The time management should be done by management. If you are paid on an hourly basis, your management needs to approve your hours. And then your payroll should be processed by the payroll department. Proper segregation of duties. If HR is in charge of approving paychecks and paying you, there is no segregation of duties. If management is in charge of approving your hours and paying you, no segregation of duties. Okay, unclaimed paychecks, property of the state, and after 6 months needs to be submitted to the state for unclaimed wages. Okay, remember, payroll is the largest expense, and the way you start is you run a payroll summary report and go backwards and try to, sometimes many auditors will, when they distribute paychecks or pay stubs nowadays, as majority of them are direct deposits, they will walk with management for the existence test. They will take a payroll summary report, they will look at payroll taxes, they will match the accruals, because remember, the 941s and the state taxes are paid by the 15th of next month, so proper accruals. Have they been made on December 31st? These things need to be verified, or any other period. Okay, so these are the things that you are trying to match when you are doing payroll. Footings of payroll. Are there any accuracy related issues? Has payroll been processed correctly? Okay, any extraordinary fluctuations in salaries and wages? Look at board of meetings, directors board of meetings for authorizations. When you look at all these things, okay, what you are doing is you are questioning, you are looking for accuracy, and you're trying to see if overall payroll has been processed correctly, there are proper segregation of duties, etc. Okay, so you need to keep that in mind when you're doing this. Accrual is very important for tax purposes. Computation of sales commissions, bonuses. You may do your own computations and verify with what has been approved. So by doing this, you are trying to assert that the largest expense in many cases, or largest operating cost, is being checked and double checked for accuracy. Once you have looked at payroll, you also need to browse through cash flow. Now, you're not necessarily going to do a detailed audit of cash flows, but what you're going to do is you're going to look whether the net income that you begin with on an indirect cash flow statement matches with net income on P&Ls. Okay, you may do limited substantive procedures, like you may analyze increases and decreases and verify if they are justified, etc. But not a whole lot of work for testing goes, but you will try to analyze for accuracy. Now, of course, if you find problems, then you may have to alter your procedures and you may get into it. At the end of the day, your judgment is online. You have to be confident. You may do more, you may do less, but you start with year after year. If you're doing an audit, you have extensively looked at the balance sheet, you have asked a lot of questioning. This should fall in place. Okay, that's what I'm trying to say. If it does not, you may need to do more auditing, more testing. So once you look at payroll, once you look at cash flows, now you're ready to start the completing process for this particular audit. And that's what leads us to this part. So let's take a quick look at this and let's review this by stopping this recording, and then we can discuss further. I want you to read right up to here, so when I talk about this, it makes more sense. Okay, let me do that. So now, prior to completion of audit, look at subsequent cash payments to make sure that these are expenses for the right period and they have been booked. Okay, review the minutes of meetings to see if everything that needs to be included in the financial statements or the footnotes, everything important like related party transactions, issuance of new stocks, everything has been verified. Okay, ending analytical procedures to see that the new or the adjusted financials look reasonable, and then any contingencies. We talked about, you may have learned this in your intermediate accounting class. For loss contingencies, should be reflected in the financial statements. Loss could be probable and has to be reasonably estimated, then it is reflected in the financial statements, the contingency. Okay, of course you talk to an attorney who is in charge of this case to find out. Reasonably possible that a loss has been sustained should be disclosed in notes to financial statements. And you did not need to disclose it when the possibility of loss is remote. Okay? You need to keep all these things in mind. These rules are important for disclosure of contingencies because you're going to see some questions on multiple choice. Then we're going to discuss subsequent events and what are you responsible for as an auditor. Conditions existing before the balance sheet date that you find out about subsequently. You will need to adjust the financial statements. Conditions arising after the balance sheet date, you will have to consider those as to what kind of disclosures you need to make. Date of the audit report. Perform audit procedures to search for events. You are only responsible for information that comes to your attention after the audit report, okay, because you're not going to search. And once you do that, there are some rules that you need to keep in mind as well. So let's talk about those rules. Review latest financial statements, because by the time you issue the December audit report, you could well be in March and the first quarter of the next year may be available. Look for minutes of the meetings. Talk to management. Get an attorney's letter for any pending litigation. Obtain representations from management concerning any subsequent events. Okay? Those are the things that you need to be careful about. And any correcting known misstatements, let's talk about that. How are you going to correct that? You call it unqualified, actually it should be called unmodified. So make sure you make that change. Okay, so now that you have read this, let's talk about this. What, in a sense, is the materiality concept? Okay, any known misstatements must be corrected, and all adjusting entries need to be put in a separate folder. You can only issue an unmodified opinion when the aggregated misstatements are significantly less than a material amount. So let's take a look at this. Review this chart and then we're going to talk. Your current assets. Total likely misstatements is this much. What is considered material? This much. Look at this total likely. What is material? And what it says is when the aggregated misstatements are significantly less than a material amount, only then an unmodified opinion is called for. Total likely misstatements are small enough in amount to result in a sufficiently low level of audit risk to justify our opinion. Okay, materiality matters, and so I would review this for a few multiple choice questions. You also then need to look at prior misstatements and the rules related to that. Here's the rule. If prior year adjustments and current year adjustments are material, we need to adjust the financial statements for the total of current year. Previous year adjustments is material for the current year. By current year standards are material, adjustments should be made on prior year financial statements. If the previous year amount by itself is immaterial, adjustment should be made as an expense to the current year financial. Those are the rules. Okay? Here's a current year misstatement. Here's a carryover from the previous year. If either 85,000 or 147,000 total is material, adjustment has to be made. Okay? If the 62,000 is immaterial, it will also decrease current year income. If 62,000 is material, we need to readjust in the prior year's financials. Again, rules that you need to know for successfully answering multiple choice questions. So this is for prior year misstatements. We now move to other financial information disclosure. Okay, what are the other things that we need to disclose? Now, what kind of information are you going to disclose in the footnotes? As you know, the companies usually will, with the audited financial statements, include the annual report of management. Okay, and that information could be other information, required supplementary information, and supplementary information in relation to the financial statements as a whole. So what is your duty as an auditor related to these statements? Not information that is not required but is helpful. You are required to read it for any inconsistencies in that annual report. Required to disclose certain information by agencies. You need to audit this information. Look at supplementary schedules. An auditor's responsibility again is to verify any inconsistencies as well as inquire from management how information was prepared and obtain representations if necessary. Okay? Now, you need for this information, which is related to the financial statements as a whole, supportive information included by management to make their case in the annual report. Your responsibility is to gather an understanding of the information and, if needed, obtain written representations. Management may choose to include an additional paragraph for emphasis of matter based on the criteria listed below. Okay, and you need to review this. Based on management's understanding for supplementary information, they may decide to include an additional paragraph. Regarding this other financial information, you, the auditor, you will have a responsibility to read this for inconsistencies and material misstatements, and you may need to modify the report based on your judgment. Okay? These are certain rules that you need to keep in mind. Again, certain rules that you need to keep in mind. Okay? So, emphasis of matter, effect an audit report if properly presented. The proper way is the paragraph, other matter or emphasis of matter indicates that information is incorrect or omitted as appropriate. The audit opinion remains unmodified. Okay? So you need to understand these rules in the event of any changes that are required. Okay? In the standard unmodified report, and in the event an additional paragraph needs to be added. Okay, so these are certain rules that you need to keep in mind. You are now ready to wrap up, but before you wrap up, you need to follow certain rules, and those rules have been highlighted in the second section of this particular chapter. Okay, so what does this chapter talk about? Indirect verification of income statements and direct verification of income statements, payroll, cash flows, and then subsequent events, contingencies, and then finally rules for materiality for prior year misstatements. And that concludes chapter 16 and on to chapter 17.